Ladies and gentlemen, welcome to this insert on valuations. It is a continuation of the videos we've already provided you with on valuations, and this particular one is the first of a set of 3 videos in which I'm going to take you through the determination of a minimum and a maximum value for a particular stake in a company. Now, what I would like to do in this particular video is set the scene for you as to what the problem is. Why do we need to, in a particular set of circumstances, in fact do 2 valuations for the same stake that we're looking at? And so what I would like to do then is to set the scene for you in video 1 of what are the factors at play here, and then we are going to delve into 2 further videos where in a little more detail I'm going to look at 2 key areas. As you will see later, the one is typically with a merger or acquisition. We have an issue that it is in particular under those circumstances that you would develop what we would call or term a range of values, as one would also do when you are valuing a business in distress. So I'm going to unpack that for you in this video, what the problem is, and then in videos 2 and 3, how do we address the problem and work around it. Now, maybe just an important juncture here, and that is I want us to reflect on the journey that you have been on in the learning area of valuations. And some of the things that along the way you should have picked up on. So the first issue was you were introduced to this learning area at an FPS 300 level at UP when my colleagues dealt with probably the first 2 valuation methods that you would have been exposed to. That is doing a valuation of the earnings of a company, typically when you are valuing a controlling stake, you would have learned, and then valuing, on the other hand, a non-controlling stake or a minority interest using a dividend approach. Now, although that is important, I think what is more important is that during the 705 lectures that have been presented to you already, you then explored probably the more evolved forms of valuations, the more important ones done in practice. And so we've really tried, and we're going to continue to try as we develop and unpack this topic for you, to focus on the issue of what in practice is important to consider. And so I just want to reiterate what we've said before. Remember, Financial Management 705 is a subject that you learn by doing. There's no quick fix. And so unfortunately, in terms of this area as well, you need to understand what the issues are that I'm going to unpack for you, be aware and mindful of them, and that you then are able to apply them in a given scenario. So what then has been added on 705 level to date? Because I expect that to now be embedded knowledge. In your previous set of videos that you would have watched on valuations on the 705 level, you were introduced to the concept of value, and you were introduced to the various kinds of values that we get. Now, amongst those are 3 very important values that I need you to seize onto in the next 3 videos that we're going to be talking through the issue of calculating a range of values. The values that I'd like to emphasize, and I'm going to continually emphasize them throughout, are firstly what fair value is, secondly what a realizable value is, and thirdly what a liquidation value is. So I will be at various stages, in particular of this first video, honing in on those, and then later on, for instance, with businesses in distress, we will have to consider very carefully whether a realizable value applies there or rather a liquidation value. But in terms of setting the scene, I'd like to unpack then the issue that we have with any range of maximum and minimum values. Now, in thinking about this topic, I thought it might be worth my while to take you back to your transfer pricing knowledge and your transfer pricing lectures, where you were taught that companies that transfer goods or services internally and charge a transfer price, fee, or charge for that will also set a range of prices. At the one end of the spectrum, they will have what is known as a minimum price. And that minimum price is really what the seller expects to be compensated for. Now, in a transfer pricing environment, that is, at least let me cover the additional costs I'm going to incur in transferring these goods or services to you. Now, what is the similarity with a valuation? A minimum value, as you will see during this presentation, is also going to be from the seller's perspective. And that is the minimum value, really, that they could expect from any buyer. And it's what, from their perspective, that particular stake is worth. Now, in a transfer pricing environment, you would have learned that the maximum transfer price is set from the buyer's perspective. And what would you know? The same will apply here. With a maximum value, in terms of a valuation, the value is also determined by the buyer here. And what is the basic principle? And it applies both to valuation and both to transfer pricing. The maximum value that anyone is going to be willing to pay, whether it's for goods being received through the transfer pricing system or in terms of a valuation, it is the maximum I am willing to pay is the maximum value that I can derive from what I'm getting from you. And so there are very big similarities in terms of from whose perspective the minimum and the maximum values will be determined. But beyond that, obviously, there are a number of additional principles and complications that come in with a valuation, which definitely are not present in a transfer pricing problem. But what I'd like to do now is to spend a little bit of time taking you through the contextualization of the problem at hand. And that is that drives the need for setting a minimum and a maximum value for a particular stake. And so I thought it very important that we start off by going back to a definition that you have often seen. And that is the definition of a fair value as defined in terms of IFRS 13, which says that a fair value is a price that would be received in selling an asset or having to be paid to transfer a liability in an orderly transaction between market participants at a measurement date. Right. So the two key issues to take out of this here is that a fair value can only apply where there's an orderly transaction. Now let's stop there for a minute. What does that specifically scope out? If the sale of a stake, such as a number of shares in a company, does not take place in an orderly transaction, what would the opposite be? A forced sale. And that is the problem that we're going to talk about when we in video 3 have a look at how we would go about valuing a business in distress. So the first issue is fair value would be for any orderly transaction. And so for a merger or an acquisition, any purchase of any stake, barring in a scenario where there is a business in distress? We would assume that the transaction would be orderly, and so a reasonable value then could then be, and this is scoped in here, a value in use or realizable value. Which of the two? Remember, the premise of value states it will always be the higher of the two, because any seller would never settle for accepting the lesser of the two for a stake that they are selling to you when they well know that, for instance, if the company has been performing poorly and the shares are undervalued, but the realizable value of the net assets is higher, then surely they would say to you, well, if you do not at least offer me that, then I will liquidate the assets, sell them off, repay the liabilities, and leave with the cash that I get in that process. So that's the first important point. It's an orderly transaction. But now comes the real crux. Between market participants, does IFRS 13's fair value definition tell us who those market participants are? And the answer is no. That buyer that we're going to start talking about in this context is a buyer that has not been specifically identified. And so very, very key here to your understanding of the problem is that IFRS 13 is basically saying to you that we are looking at it here from the perspective of any buyer in the market. And so that buyer is in fact identityless. Now, the complexity is going to come in when we say, but hang on a minute. When I look at this transaction from a particular buyer's perspective, we now identify the buyer, they take on an identity, and I now need to look at the maximum value from the perspective of, well, now surely we should customize this valuation. But more about that just now. So, let's unpack this definition, and there is one key problem that I'm going to identify, and as you will see there on your screens, it is around bullet 2. Right, so the first issue is we are basing it on exit price. Thank you, IFRS 13, but here comes the crux. It is really, the principle here is a fair value is what any buyer should be willing to pay and any seller willing to receive. Now, this brings about a number of key questions that we need to think about. So the first, as I said to you, there is, please remember, this is a nameless, identityless buyer under a fair value. Because he's saying the seller couldn't care. This is maybe the crux here. The seller doesn't really care who the buyer is. The seller is aware of what that value to them is, and that is what they want to be paid. Now the problem is, when the seller considers who, and this is where we deviate from the fair value definition, who a particular buyer is, then the seller is going to have to start considering what the specific conditions and circumstances are around the particular buyer and what value is being created for them. And so from the minimum value perspective, and that is why very often a fair value will be the minimum value in the range that we're going to talk about here, is really what the market is, what any market participant is willing to pay. But as I said to you, when the seller becomes aware that the particular market participant who they are going to transact with is going to generate more value than any other buyer would, that is the problem that we now have at hand. So, what can we deduce from that? From the seller's perspective, please note, and that's why I said to you, fair value will always be from their perspective. It cannot be from the buyer's perspective, because as soon as we shift to the buyer, then we have to say, but hang on, what value is the buyer going to generate from the transaction? But the key principle is really what I tried to bold there and amplify for you, is we exclude any additional value being generated here. So no additional value being generated here beyond what the seller believes any buyer would be able to obtain as value and therefore be willing to pay. And so as I said to you here, this is a nameless, faceless buyer from the seller's perspective. So the minimum is really put me in the position that any other buyer would pay here. And then, as I said to you, and here comes the crux. But when the seller becomes aware that a particular buyer is being placed in a better position through acquiring that stake from them, then is the seller not going to, in their heads, rationalize this and say, but hang on a minute, if I am creating this additional value for you that no one else would be deriving from this investment, should you not be sharing that additional value with me through paying me more? And so the difference between then the minimum and maximum value is that we will start with the maximum value by looking at that from a particular buyer's perspective and not from the seller's perspective. And there we will factor in these additional benefits that they supposedly will generate. Now, in most cases, we probably would not include a premium in a fair value of a share unless we are looking at a block of shares, a large enough group that on their own provides the holder thereof with control. So the problem that we now have is we're saying, well, from the seller's perspective, the minimum they would expect is what anyone should be willing to pay for them, to pay them for the stake that they're considering selling to that party. So what would we bring into that value? Well, surely, because there are no additional benefits that anyone else would be generating here, it would be to value from the seller's perspective what value they place on that stake. However, as I said to you earlier, when the seller, however, is aware that the buyer is going to derive additional value, then we need to go and determine a value from the buyer's perspective as well, and that is the maximum value by which their value will increase. And I will re-emphasize that repeatedly through this discussion so that it sinks in. So let's just confirm then where you are going to go with from here onwards on this journey. In certain circumstances, and we're going to explain to you shortly what those circumstances are, there will be a need to calculate, and by doing that, perform two valuations for the same stake. A minimum to the one extreme being to place a value on the shareholding from the seller's perspective, as I said, and where there are a group of sellers looking, and this is very important, looking through to the stake here to say, buyer A is looking at buying 30%. Now, 30% could give a certain amount of control to buyer A, but from the seller's perspective, each of those sellers only owns a 6% shareholding. Can you see here the problem that we have? If I value the 30% as one single block of shares, I place a different value on it to looking at the individual stakes and negotiating with the individual shareholders who only each hold 6%. Right. So, from the seller's perspective, looking through at what the particular seller's shareholding is, not looking at the block of shares being sold, but where there are a number of sellers at how much each of them owns. Recognizing number two, that we're doing it from the seller's perspective. And so if I need to value a return from their perspective, you would have learnt in all your 300 lectures on valuations, as well as the videos up until now, that when we place a value on, from a minimum perspective, from the seller's perspective, whose risks and growth prospects do we factor in to the multiple or yield that we're going to value by? Those that the seller is confronted with or exposed to. What about the WACC or KE if we are doing a free cash flow or discounted cash flow? Whose would we use there? It would be that of the seller, because the seller's KE, the seller's WACC, compensates the seller for the risks that they're exposed to. And so any buyer buying that stake, any nameless, identityless buyer, would be exposed to the same risks, hence the same required rate of return. Now that's very important, because when we then get to the second value in the range, being the upper limit, which is the maximum value, we are doing this valuation from the buyer's perspective, who is going to place a value on any additional benefits that are going to arise for them. Now, with a merger or acquisition transaction, in certain cases, as we will talk about later, additional benefits arise in terms of what we call synergy. And so where synergy is going to arise, and the seller is aware of it, the buyer needs to then remember that the seller cannot negotiate upwards, the price upwards and upwards and upwards on an endless scale. At some point, that seller would expect to be paid more than what the buyer's increasing value would be. And at that point onwards, the buyer in fact would destroy value because they would be overpaying for that stake. And so for the maximum, it will always be from the buyer's perspective. We're going to place a value on the benefits that are arising specifically for them. But a very key issue, we are going to see this as a single block of shares. And the English there is very fancy. I can never remember whether this block, when we're talking about a block of shares, actually has a K in it. I don't think so. So if you're a language wizard, forgive me. I think it is just BLOC. But that is a bulk, a large quantity of shares being valued together, that single block. So we're going to value that together, although we might be buying as the buyer that those different stakes from various sellers to make up that combined stake. We are going to place a value on the entire stake there. Right, and that value becomes then what is known, as I said to you there, the upper limit in the range of values. But now the crux. When you do a valuation of a maximum value, whose perspective are you doing it from? The buyer's. We are in fact customizing the valuation here, because we're saying this buyer is no longer nameless and identityless, like IFRS 13 really purports them to be here. We are saying this buyer is Mr., Mrs., or X Limited. If I do a customized valuation from their perspective, I'm saying what is the value they are placing on it? And then surely the value they are placing it will be using their required rate of return. Now, if that is the case, then if I'm valuing earnings, whose price earnings multiple do I use as a starting point? That of the buyer. If I'm valuing a discounted cash flow or a free cash flow, whose WACC would I use? If I'm valuing free cash flow to enterprise, that of the buyer. If I was valuing free cash flow to equity, whose cost of equity would I use? That of the buyer. If I was doing an EBIT, EBITDA, or sales multiple, whose multiple would I use as a starting point? The buyer. But one thing I want you to think about as we go on is, will the buyer blindly apply the current rate of return that they would expect from any investment. Now think carefully. Why do they expect that? Because that is in fact what they are being valued at by the market. So what the market is doing here is saying, when you buy this stake here, we will continue valuing you at that particular multiple or rate. Unless what? Your risk profile changes. Now, where the risk profile of the buyer changes because of what they buy, the market will reassess the rate at which the market values the buyer. And then surely we would argue that that is the rate that we should be using. Now, when will the market reassess the rate and say, but hang on a minute, we need to reassess the risk profile here? When will the market do that? And the answer to that is very plain and simple. The market will only reassess the risk profile of the buyer where what the buyer is buying here is large enough. I apologize for that light moment. That was just those were two of my cats wanting to kill each other. So you can laugh quietly in your shelter wherever you are listening to me from. Right, so coming back, when will the market reassess the risk profile of the buyer? As I said, when what is being bought in value terms is significant enough to actually change the risk profile of the buyer. So maybe to give you a little very simplistic example. If Pick n Pay was to buy a spaza shop in Soweto, for instance, a little general dealer effect located next to, say, one of the taxi ranks in Soweto, do you think that the risk profile of Pick n Pay would change given the acquisition of the business of that particular spaza shop? And the answer is no. It is too small. But if Pick n Pay was to acquire a controlling stake in a company such as Spar or Shoprite Checkers, if Spar or Shoprite Checkers, depending on who the acquisition is made into, was to fail, then it actually jeopardizes the value of Pick n Pay substantially. So in a case like that, we would say, wait a minute, we need to reassess here. And that is what we in fact would do. So in video number 2, when we in particular, this is very important and relevant to the valuation of a merger or an acquisition, we will always question before we start off with the maximum valuation. Must I use the buyer's rate? Yes, the answer will always be. But do I need to adjust it? And for that, I need to always consider whether what is being acquired here is so significant or material that that acquisition can significantly impact on the value of that buyer. And given that, their risk profile, and then the answer will be, but if that is the answer, you then need to adjust the rate of the buyer before you do the valuation. But more about that in the later insert. Now back to our definition. The third bullet there, you would have discussed earlier. I'm not going to add anything here because this is more of a finicky technical issue relating to fair values than addresses the particular problem that I'm trying to unpack here. And then the other is just to remind you, because it's going to become a problem later on, when we deal with minimum values and with a minimum value specifically in a minimum maximum value scenario, where we are valuing a business in distress, where the minimum value then probably lies in a liquidation value. Now, please remember, in a case like that, a liquidation value could never, in a minimum value that we're placing on an interest in a business in distress, that minimum value being a liquidation value could never be considered a fair value for that stake, because it is a forced sale taking place with the liquidation, not an orderly transaction as mentioned earlier. Right, and then the last two bullets here, just to very briefly refer to that, because I'm going to deal with that in a separate video on its own, is IFRS 13, I think, actually has taught corporate finance people a very valuable lesson. IFRS 13 says, you know, when you do a valuation, it is so subjective. The inputs, in particular, around setting a rate, such as we do for an unlisted investment rather, or an unlisted company that we're valuing, deriving that rate is so subjective that automatically you can question whether the value is reasonable. And so when we talk a little bit about how to perform a reasonability test, especially after I've unpacked the minimum maximum values here, that is going to bring about its own interesting dynamic for you. There are two key things here that IFRS 13 says pass up for. The first is, IFRS 13 says, when you determine a value, please go and stress test it. Stress, as a CTA student experiences, stress test, go and determine for that same block of shares or same stake that is being valued. Place a value valuing different alternative returns. So if you've done a free cash flow, you can't believe that that value derived is a given and that is cast in stone. IFRS 13 says, no, wait. Go and test this by performing a valuation on an alternative basis. For instance, you could, in a reasonability test, go and say, right, I've calculated this value here for the operations, for instance, through a free cash flow. What kind of a value would that give me if I knew what the EBITDA multiple is that's reasonable, or an EBIT multiple, or a sales multiple, whatever the case might be? And so I'll unpack that for you there, but there are two very important issues therefore at the bottom of this slide. IFRS 13 says, stress test, apply various valuation techniques to valuing that stake, and always try to limit the subjectiveness by basing your valuation on observable inputs rather than subjective inputs. Now that is very easy when you're dealing with listed shares, or you're dealing with some kind of an asset, for instance, that trades in the market, and you could say, well, what did a similar asset trade at? But where the subjectivity is going to come in is always, for instance, if you want to value a brand or a patent, you might say, well, a similar one recently sold for X. Similar to what extent? This might be very unique, so it could be similar, but it's not identical. So there will always be judgment here and subjectivity, but we want to try an evaluation to limit that. And so IFRS 13 is reminding us that because of this inherent subjectivity here, we need to be very careful when we determine a reasonable value. Now, in building up our case for developing a minimum and a maximum value, first thing I thought that we need to sort out with each other here is you need to understand the link between the level of control that the buyer is going to get and what they need to pay. So, this purpose of this slide is to just set out the different control thresholds. Now, as I said to you at the start there, please remember control in our valuation environment is always linked to voting rights. And so we assume that you can exercise the amount of control that you have in terms of the voting rights that you then have given the stake that you own. So, as I said to you, their voting rights are the dominant indicator of control, and the key control levels are as follows. From just in excess of 0%, because obviously if you have no stake, there's no question around control. So from 0.01% to 25%, this is the lowest level of control from our perspective. Accounting or financial reporting says yes. At 20%, you can exercise significant influence, but influence does not equal control. And so when we are talking about control, we would be looking for the higher thresholds, control thresholds that I'm going to get to in a minute. Now, as soon as you move beyond 25%, we now get into an interesting territory. In the Companies Act, you will be aware of two kinds of resolutions that shareholders can pass. The first is a general resolution, which is 50% plus one of the voting rights need to be exercised in favor of that resolution. Right? Is that applicable here? No, because the threshold is up to 50%. So any shareholder owning 50% cannot push through on their own a general resolution. But what is important is if you are a shareholder in these parameters here, between 25.01% and 50%, you can fend off on your own a special resolution. And remember, all the significant kind of business decisions, such as selling off the majority part of the assets of the company, key changes to the memorandum of incorporation, to the shares in issue, etc., would need to be approved by means of a special resolution. And so there is a certain amount of control existing here. And so, if you are a buyer buying a stake in excess of 25.01%, you are definitely developing a certain amount of control for yourself here. And that seller would probably want to benefit from that in terms of what you're going to pay them. And so this is where we start talking about a premium for control needing to be paid for that stake that you're valuing. Then from 50.01% to 74.99%, we recognize that this shareholder can push through a general resolution on their own. So from a Companies Act perspective, there is control. From a financial reporting perspective, because of that control, this level here is what triggers the need to consolidate. But from our perspective, from a financial management or corporate finance perspective, we would be placing a premium on top of the value here that we're going to place on the stake from the buyer's perspective for that control that they can exercise. And so in a scenario like that, where control manifests because of this, at minimum, we would build in a premium. And just now, in one of the slides that's going to follow on a little later, I will take you through some interesting transactions here as to whether minimum maximum applies or we merely need to consider a control premium. Now, just to go back one step, the Companies Act in the takeover regulations, which are at the back of the Companies Act, they specify that for certain transactions, a control threshold of 35% will apply, 35% or more. So in that band of 25 to 50, as soon as you're hitting 35%, the takeover regulations say, but look, here is a significant amount of control already. And so shareholders would therefore expect, under those conditions, to be compensated for that. And then the last parameters here is 75% is what you need to push through a special resolution on your own. So any shareholder owning 75% or more of the voting rights that they therefore could exercise has a very high degree of control, and they would, in acquiring that level of control, need to pay a very significant control premium for that. So as I said to you at the bottom there, please, in terms of the level of control, the higher the degree of control that they have in terms of the thresholds, the higher the premium typically will become that they need to pay. Now, why is that the case? We believe that through control, those shareholders having, or that shareholder having control, can in fact impact on the value of the company. And because of that, the seller would expect to be paid a premium, and the buyer, given that that additional benefit that they have and flexibility of being able to influence and impact on value, should be willing to pay a premium. And so the impact on the value of the enterprise then, from the perspective of a controlling shareholder, will be that the controlling shareholder can influence a few very key strategic issues around the enterprise or business. And so because of that, the fact that you are part of the strategic planning, the policy development, the implementation of that policy and strategy, and making the right to make certain key strategic decisions, is definitely a way of influencing the future of that company and hence the value. You would also be able to influence who the company buys from. In other words, who its key suppliers would be, and in the same breath, who the company sells to, who its main customers will be. So these are a few very key operating decisions, and for that, we associate a premium with that right to influence. And hence, it would be included in the valuation of that stake. Right, and then as I said to you there, you can also influence the remuneration policy in terms of setting it, approving it, etc., and amending the memorandum of incorporation. But what's interesting is to stand back and say, but as a controlling shareholder, you also set the reinvestment policy of the company. In other words, through doing that, the portion of the earnings that are distributed as a dividend and the portion that is plowed back. And that is very key. Because remember, from a financing perspective, that to the extent that we plow back, we're creating internally generated funding, which we can use to fund our growth strategies with. So it's very important for the controlling shareholders or shareholder to be able to exercise their control in setting the dividend or distribution policy, because it is going to impact on the value of the company and the value of the equity ultimately. So as you can see there's an interesting differential. We're saying here that through control, you don't only influence the value of the enterprise or the company or the entity, you also impact on the value of the ordinary equity. Now, what I've done for you is I've given you 4 separate scenarios. We are going to consider each one of them, and the question will remain the same for all 4. Should we, in that particular scenario, calculate a range of values, the minimum being the lower limit, the maximum the upper? So to keep things simple, I've tried to keep the different parties here the same. And so we're going to start off then with the buyer being company A that is acquiring a stake, and the stake is what I will explain to you in each of the separate scenarios in company B. Right. And I want you to be aware, as I said to you here, that the seller is aware that the buyer might, in certain cases, be generating more value than another buyer would. So let's look at the first one. Company A, or A Limited, acquires a 26% stake from a single shareholder. Now, what should start flashing in the back of your minds here is when we looked at the levels of control, this acquisition here, or this stake being bought rather, let me be careful of the terminology I'm using here, will allow the buyer to fend off on their own a special resolution. So they have a degree of control. Yes, it's not big enough to be able to push through a general resolution on their own, but they can fend off a special resolution. And so this seller would probably expect a control premium here. Now, would we need here to apply or calculate or set a range of values, a minimum and maximum? And the answer is, well, if this buyer generates no further benefit than that this buyer is going to only get a 26% stake through buying this 26% stake, then any other buyer buying this 26% stake who would also be generating no additional benefits, they would all be willing to pay the same for it. And so here, in the absence of any further information, we would probably say I will, in the valuation, add a control premium, but there's nothing here telling me that on its own I would need to calculate a maximum and a minimum value for that 26% stake. Now, when might that differ? Well, the next example is going to take us to that place. So, just to confirm then, no minimum maximum range there. Single value placed on the 26% stake. A Limited already owns a 36% stake. So very, very key here is that they already own that 26%, that 36% stake rather. And now they are considering buying an additional 15% stake. Now let's look at this very carefully. Any other buyer buying a 15% stake would be obtaining no degree of control here, you would all agree. But what happens to A Limited acquiring that 15% stake in B? A Limited's control increases in B to beyond the threshold of 50% plus 1. Now, how does that impact on our valuation? Remember we said the minimum value is from the seller's perspective. So the seller's saying if any buyer was to buy that 15% stake from them, what would they accept as a minimum? And that is that 15% on its own gives no one control. So the minimum value would be calculated on that basis. But now comes the problem. When I now say, but who is the buyer? Hang on, it's A. Oh, A is a shareholder already here. I then need to say, but A's total shareholding becomes 51%. What is the differential now? They have a higher degree of control than any other buyer would here. And because of that, this seller will expect to share in that added benefit. And so in this case, indeed, we would need to determine a minimum and a maximum value. And so we can tick that with confidence. Now the third one. A Limited has no shareholding in B as of yet. They acquire an 80% stake in the latter. Now, that 80% stake would give any buyer of that stake control. Okay? And so any buyer would be expected to pay a control premium. However, I'm giving you some more information here. These shares are held by 17 different shareholders, holding respectively between 2% and 18% of the shares. Does any of those shareholders have a controlling stake on their own? No. And so the dynamic here becomes very interesting. Any buyer would have to pay a premium here, but it's only that if the seller is aware that if they sell together with all the other sellers, control arises, then we would need to differentiate here and set a range within which this buyer and seller would negotiate. Because the seller probably would want a premium here from this particular buyer. Now, to just confirm this, that you will definitely have to place a minimum and maximum value here, is I now tell you that substantial cost savings are going to result for A and B together, the combined entity, and that the combined entity is going to command a greater market share. Now, if the sellers of those stakes are aware that through them selling their shares to A Limited is going to generate these cost savings. What do those cost savings do? They increase their value. And they're going to command a higher market share after the transaction. Then those sellers are going to say, but hang on a minute, I want to share in your loot here. And so definitely we will have to calculate a minimum maximum here. Can you, on reflecting back here, see that additional benefit arising for this particular buyer? And that if the shareholders of this, or the sellers are aware of that they would expect compensation for that from this shareholder versus probably not from another one. Right, but because this shareholder is buying that 80% stake, they get the benefits here. We would need to do two valuations here. And then A Limited. Now I'm changing A Limited and what it does slightly. A Limited is a private equity fund. They intend on buying 100% stake in B Limited. Now, from a control perspective, what dynamic does 100% bring about? There are no minority stakes involved here anymore. So there is no one that can stand in your way in pushing through any decisions whatsoever. And so for that, you will pay a very high control premium, the highest that you would for any stake being purchased. But now I add a different dynamic on here, and that is that this business is in financial distress. A Limited, the buyer's management team believes that they, however, through implementing turnaround strategies here, could in fact turn the business around. They could in fact extract value here. Now, not every buyer, number one, would probably be able to do that, but number two, here comes a problem. In order to extract that value, A Limited, in addition to buying the shares, are going to have to pump cash into B Limited to put it in a position to start generating or creating value. Do you think here we would need to differentiate between a minimum value and a maximum? And the answer again is yes, but why? That value creation is contingent upon the cash injection being made. If no cash injection is made, this company is going to die a slow death and be liquidated. And so here, any buyer not willing to make a cash injection would probably only be willing to pay the liquidation value of those assets. On the other hand, A Limited, who is willing to pump cash in here, will extract value. And the shareholder will be, the seller here, would then like to be able to have a value placed on that value that potentially could arise because they want to share in it. But now the seller is going to, the buyer rather would say, although we've placed a value on the value we can extract, excuse me please, I've got to make a cash injection. So I want to reduce that stake by that cash injection I have to make. And so we will definitely set a minimum and a maximum here, or a range of values. And so, ladies and gentlemen, just to recap then, before we move on to video number 2. And that is, can we now summarize by saying, when do you need to be careful in terms of being that you would be triggered to consider whether to apply or calculate here a range of values or not? And I've tried to group it under 3 headings. When any of these 3 issues apply, I want you to please sit back and reflect here and think carefully that a minimum and maximum should be calculated here where there is an enhanced level of control, firstly. That is that example in the second scenario we've just looked at, where the buyer already holds shares. And through buying an additional stake, which for any other buyer means no control, this buyer gets control. They would have to pay a control premium, whereas no one else would. And so there would be a need here to look at setting a range here, the maximum containing the control premium, the minimum not, and that range would allow for this buyer and seller to negotiate within those 2 parameters, or between those 2 extremes. Then number 2, with the merger acquisition, and that is the topic of the next video, what are the issues here? Firstly, there is control being established from the buyer's perspective, as you will see. And secondly, the second key issue is that depending on who the buyer relative to the seller is and the industries that they are in, particularly if they're in the same industry, then synergy, and I'm going to explain to you what synergies are that you need to consider and how we place a value on them. We then will go and place a value on that stake. And then finally, businesses in distress. With a business in distress, we have the dilemma or the complexity here that a particular buyer might be willing to pay a little bit more because of the value that they see that they can unlock there. But that value can only be unlocked if they make a cash injection. And so we will always reduce the maximum value that they place on a stake by the value of that cash injection. And that you'll see in some of the questions that you're going to look at. But that issue and how we value a business in distress, I will unpack for you in more detail in video 3. So all that's left for me to do, there I am, is to say thank you for listening. I hope I've added value, the pun being value, and that you understand what the problem is now. In the next 2 videos, we're going to have a look at how we can address the problem through the valuation that we're going to do.